hopefully with my technology experts, we can get this posted to our website. So hopefully you should have sound, and hopefully you should have on your screen taxes and retirement, which is our topic for today. We are, again, recording this call so that we can post it to our website. We plan to do webinars such as this with varying topics on a quarterly basis, and more often if you ask me to, and I would welcome your suggestions and recommendations as to topics that we cover in the future. Our next event coming up, our next client event, will be a client mixer on Wednesday, October 18th, so look for information coming from us in the coming days on that. Our goal this afternoon is to cover this topic, taxes and retirement, in 30 minutes. I may go over slightly, but I will not go more than 45 minutes. So if I go to 45 minutes and I'm still talking, go ahead and hang up and log off, because I didn't keep my promise to you. So my goal is to do it in 30. And as I mentioned previously, we will be recording this so that those that log in late, or if I went too fast on a couple of items, we can go back and review the recording at a later time. So let's move forward. Welcome. We're glad you're here with us this afternoon. This is going to be a wonderful topic. My goal is to make a very complex topic understandable. And so at the end, you will have some questions, but hopefully it'll be more understandable than it was when you first signed up for this webinar. First of all, I have to give my disclosures. So here are my disclosures. As you all know, I'm a CPA and I'm a financial professional. I'm not affiliated with the IRS or any other government agencies, and what we cover today will be things that I see in my practice on a day-to-day basis, and they are not, what we cover today is not intended to be specific advice for anyone on this call at all. Our goals today are to understand the laws as they are today, not the laws as we wish they were or that we hope they would become. We're going to cover just what is, and torpedo some of the misconceptions that we have about taxes during our retirement years. And then we'll also cover some of the tools and strategies that are available to us during our retirement years. So our first graph, you'll all be thrilled at looking at something like this. This makes Kate's eyes go crazy when you start looking at numbers and tables. But this is just a standard married filing jointly tax bracket table or chart. So on the left-hand column, you see taxable income, and on the right-hand column, you see ordinary income brackets. And we're going to go through this, but this is what we call marginal tax rates for ordinary income. So you've got the 10% tax bracket, you've got the 15% tax bracket, and the 25% tax bracket, and so on. But what we want to do first off today is understand, what does that really mean? What do these tax brackets really mean? So we're going to start off with a question. Suppose that you were at the top of the 15% tax bracket. So I'm going to go back a slide. The top of the bracket, top of the 15% tax bracket is at $75,900. So what happens if you earn one more dollar? That throws you into the 25% tax bracket, right? Because you're at $75,901. So what happens, what's the impact on your tax bill by jumping from the 15% tax bracket to the 25% tax bracket based on that one more dollar? Would your tax bill go up, A, a lot, or B, just a little bit? If you said out loud or to yourself, it would just go up a little bit, you are correct. But there's a lot of misperception around that. 52% of people ask that question get it correctly. So that means there's a lot of us that still don't understand how these marginal tax brackets work. So let's Let's go to what we used to see when we would prepare these our tax returns by hand. So if you are at, if you're in the 15% tax bracket, which is the second line here, you would pay $1,865 plus 15% of the amount that exceeds that $18,650, because the $18,650 is taxed at 10%. So 10% times the $18,650 is this $1,865. So it's already taking into account that first $18,650. So then we're just looking at the amount that falls into the second tax bracket, which is the 15% tax bracket, and that amount is taxed at 15%. The first $18,650 was already taxed at 10%. So when you jump a tax bracket from the 10 to the 15, you're not losing the benefits of the 10% tax bracket. You're still, the first $18,650 was taxed at the 10%. Hopefully that makes sense to you. And that holds true going on up to the 25, 28, 33, 35, and so on, the various tax brackets. Okay, visually, for our visual learners, this is what we call an ordinary income tax map. I'll just call it a tax map based on our ordinary income tax brackets. So you'll see the 10%, the 15%, the 25%, the 28, 33, 35, and 39 points tax brackets, all visually. But notice here that from $0 to $23,000 of ordinary income, there's no tax. That's because of deductions and exemptions. So from 0 to about 23,000, there's no tax paid. And then from 23,000 to about 40,000 of ordinary income, it's taxed at 10%, because again, taking advantage of the exemptions. Oops, how did that happen? Taking advantage of the ordinary income, or the standard deductions and the exemptions, I'm sorry. So during retirement, the two most common sources of ordinary income are pension income and withdrawals from IRA accounts. We'll cover Social Security a little bit later, but ordinary income that's taxed without any complexity, the two most common sources are pension and IRA withdrawals. All right, so those are marginal tax rates. You've got a good idea of marginal tax rates, and the idea of the marginal tax rate is that the next dollar that you earn will be taxed at that rate. Not all of your dollars, but the next dollar that you earn will be taxed at that rate. So now let's go into a little bit more complexity. We've got the capital gains and qualified dividends. They get a different tax treatment. They have different tax brackets, a different tax map. And the reason they're different is primarily because of public policy. Public policy wants to encourage investments of a different kind, different types. So they get their own tax bracket. But they do impact the brackets that we just talked about, the ordinary income brackets. So let's look at this. This is the tax map. Again, so you've got some capital gains and ordinary income or qualified dividends are taxed at 0%, and then the lion's share are taxed at 15%, and this 20% rate for capital gains and qualified dividends only applies for those that are in the highest marginal tax bracket, which is the 39.6. Okay, it's really important here and this is one of the biggest misperceptions. Capital gain taxation is actually linked to the ordinary income. Once the combination of these capital gains and ordinary income pushes you over the threshold for the 15% ordinary income bracket and into the 25% tax bracket, then your capital gains are taxed at this 15% rate. Okay, so I'll show it in a chart form that might make that a little bit more comprehensible or understandable. So you see here in the middle column, you've got ordinary income brackets. Those are what most of us think about when we think about income taxes. So we can be in the 15% tax bracket And that would mean our long-term capital gains and our qualified dividends are taxed at 0%. But as soon as the combination of ordinary income and long-term capital gains push us into this 25% tax bracket, now our long-term capital gains and our qualified dividends will be taxed at 15%. So that's a big jump. So there's lots of opportunities for us here with our middle income clients to do some planning here to try to get those long-term capital gains taxed at 0 instead of the 15%. We just need to make sure that we're working together and planning together to make that happen. Now we go into another complexity. This is adding in deductions, exemptions, and credits. I won't cover all of the credits available, and I won't cover all of the complications, but I'll just mention most of them, and we'll cover 3 of them in a little bit more detail. First, let's talk about deductions. Think of these as things that you spend money on. And that could be charitable contributions, interest on a mortgage, real estate taxes, and so on. And if that's your situation, you might file a Schedule A, which is itemized deductions. Or if you don't have enough of those to exceed the limit, and by the limit I mean, I'm going to see if I can have a pointer here. Yes, we've got a pointer here. Okay, so right here we get the standard deduction for a married filing joint return. We get a standard deduction of $12,700. So if our itemized deductions are more than that, then we're going to want to file a Schedule A. But if our itemized deductions are less than $12,700, we're going to take that standard deduction. We get a deduction off of our income, taxable income. We get to reduce it by $12,700. Then we get an additional deduction if we're over 65 or blind, and that's an extra $1,250 per person if you're married filing a joint return. Okay. Then we get the exemptions, and the exemptions are just for being alive. So for every person listed on your tax return, you and your spouse and any other dependents, it's $4,050 per person for 2017. So for a couple, that's $8,100, $4,050 times 2. Then we get some credits, and as I mentioned earlier, I won't go into detail on these, but these tax credits are dollar for dollar off of your tax bill. So the first 2 that we covered, the exemptions and the deductions, those are reductions to your income, and then you calculate the tax. Credits come dollar for dollar off of the tax. So credits are actually better than the deductions and the exemptions because they're a dollar for dollar reduction of your income tax. So let's look at an example. This example here is a married couple. Both of them are age 65, and they've earned at least $2,000, and I'll tell you why that's important here in just a second. So they've got gross income of $36,000. Then they get the standard deduction of $12,700. Then they get their extra $1,250 per person for being over 65. And then they get their $4,050 personal exemptions times 2 of them. So that's $23,300 that's going to come off of the $36,000. We're going to take $36,000 minus the $23,300. But they contributed $2,000 to an IRA. And the only time you can contribute $2,000 to an IRA and get a deduction for it is if you've earned income of at least $2,000. That's why I said of that $36,000, $2,000 of that has to be earned for us to make that $2,000 IRA contribution. This example is going to show you how powerful credits are. So now between the $23,300 of deductions and exemptions and the $2,000 that we get to reduce our income for the IRA, we've now come up with $25,300 that's going to be deducted or subtracted from $36,000. So if you take $36,000 minus $25,300, you've got income that's subject to tax of $10,700. That's going to be in the 10% tax bracket. So 10% times 10,700 is 1,070. Now here's the power of the credit. There's a saver's tax credit available, and since we saved $2,000 into a retirement account, we get a credit, a dollar for dollar credit of $1,000. That $1,000 comes off of the tax bill, not off of the income, but off of the tax bill. So the tax bill was $1,070, but we get to knock off $1,000 of it because we put money into an IRA. So we've got a total tax due of $70 when we had income of $36,000. See how powerful some of those items are. The deductions, the exemptions, and the tax credits. Hopefully that makes sense. So visually again, here's our tax map. And you see that now, because of deductions and exemptions, we have about $23,300 that is tax-free, can we say? $23,300 of ordinary income that can pass to us before we start going into these marginal tax brackets. And that's because of the deductions and the exemptions that we just covered. Now, as I mentioned, we're going to have a lot of complexity. So if we start adding in complexity, we've got required minimum distributions, we've got capital gains, we've got Social Security, we've got Medicare premiums, Roth conversions or large withdrawals from our IRAs, and we've got a 3.8% net investment income tax, we've got exemption phase-outs, itemized deduction phase-outs, and we've got the wonderful AMT, alternative minimum tax. So what we covered to now, up to this point, makes taxes look very simple. Now when we start adding these things in, it gets more and more complex. What I'm not going to do is cover all of these in this webinar today. I'm going to cover the first three: required minimum distributions, capital gains, and Social Security. But just be aware that there's several items that add complexity to our overall tax return and how everything interrelates. So first, required minimum distributions. How do they work? Why do we have them? It's primarily because the IRS has allowed us to save into 401ks and IRAs on a pre-tax basis, and their patience runs out at age 70 and a half, which means that they now want their tax dollars. So it's time for you to start taking money out of those tax-deferred plans and pay Uncle Sam. So our clients have saved pretty significantly in 401ks and IRAs over the years. That's allowed them to defer taxes into the future, but now at age 70 and a half, the tax bill comes back. So required minimum distributions are calculated on a very simple basis. What you look at is the prior year's ending account balance. So distributions that have to happen this year in 2017, you look at the December 31st, 2016 ending balance. And in this example, we're using $500,000. And in this example, we're assuming that we're 70. So this is our first one. So the divisor that we use from IRS tables is 27.4. So our balance was $500,000. The divisor that Uncle Sam says we need to use is 27.4. We do that calculation and we wind up with $18,248 that needs to come out as a required minimum distribution. And that will hit our tax return as ordinary income. So this is the table that's provided by the IRS. This is the standard uniform table. It's based on joint life expectancies. You can use this table as a single or as a married. It's the best table that you're going to get unless your spouse is more than 10 years younger than you are, and then there are special tables that you can go to that would have a slower payout. But this is the one that 95% of us use during our distribution phase. So as you notice, this is based on joint life expectancy. So each year the divisor goes down, but it goes down by less than 1, because our life expectancy goes down by less than 1. Okay, so no big deal so far. The complexity here is when we add Social Security into the mix with our required minimum distributions and our other ordinary income. So let's look at an example, because we've got capital gains now that are going to trigger. They've got some triggering impacts on how everything's taxed. And so most people think that, okay, I'm going to sell an appreciated asset. I'm going to sell some stock, and it's going to cause a 15% tax, which is logical, which coincides with the tax map that we just reviewed. But as you see in the second bullet here, long-term gains can create ordinary income tax as well. So it has almost a domino effect. And so why is that true? Because it can bump you up into a different ordinary income tax bracket, and it can also trigger some of these exemption phase-outs and deduction phase-outs that we talked about, briefly mentioned earlier. So let's review an example of how Social Security is taxed. Social Security is taxed based on your other income, and the way it's taxed, the IRS came up with this wonderful term that's called provisional income. So we have to calculate provisional income. Provisional income is 50% of your Social Security benefit, so half of your Social Security benefit, plus your ordinary income, which would mean your IRA withdrawals, your required minimum distributions, any earned income, any taxable interest. It would include your dividends and capital gains. It even includes muni bond interest, municipal bond interests. That's non-taxable. So before we move on, if all you have on your tax return is Social Security income, you would have 0 taxes to pay. It's the other income that makes part of your Social Security taxable. So let's go through some examples. We have these thresholds. For single, if you're single and your provisional income's greater, there's 2 tiers here. The 25% or $25,000 tier and the $34,000 tier. So if your provisional income, that calculation that we just reviewed, is over $25,000, then 50% of your Social Security benefit may be taxable. Then the next threshold is this $34,000 of provisional income that throws your Social Security into an 85% potentially being taxable. And if you're married, those thresholds are $32,000 and $44,000. Now, here's one of my pet peeves, and I didn't plan on talking about this, but it got to me for a second. A lot of the provisions in our tax code are adjusted each year based on inflation. So those tax brackets that we reviewed, they'll go up a little bit each year based on inflation. But these hurdles in front of us, or these thresholds that are on the screen right now, they've been in place since the late 80s or the early 90s, and they have not been adjusted for inflation at all. And this is one of my pet peeves. You can write your congressman, you can write your senator, and see if we can start getting these adjusted for inflation. But back in the late 80s, $44,000 or even $32,000 was a lot more than $32,000 is today. All right, so let's go through some examples on how this works, and then we'll tie it all together with a final example at the end. So we've got a couple. They need $60,000 to meet their living needs. So couple number one has $20,000 of Social Security and $40,000 coming out of their IRA. So that means their provisional income is $50,000. So we've got half of their Social Security, $10,000, plus their IRA withdrawal, which gives you $50,000. So this is a married couple. So $50,000 minus that threshold of $32,000 is $18,000 over that threshold. That's going to throw Social Security is going to be taxed. 50% of it's going to be taxed, so $9,000. And then the second threshold was 44,000. So 50,000 minus 44,000 means 6,000 is going to be impacted with the 85% threshold. 85% of Social Security gets considered there. So we use 35% here because 50% of it was considered in this prior calculation. So when you add 9,000 plus 21,000, that means 11,100 of our Social Security, of this 20,000 Social Security, 11,100 is going to be included in our tax calculation, so it's taxable. 11,100 of our Social Security is taxable, or 55% of the total benefit. Now, if we flip this example and say, well, let's have $40,000 of Social Security and only $20,000 of an IRA withdrawal, that drops our provisional income from 50 to 40, which is half of our Social Security, 20, plus our IRA withdrawal, 20, gives us 40,000. So our first threshold was 32,000, 8,000 of it, 8,000, half of the 8,000, 4,000 is going to be taxed. Nothing went over that second threshold, so we've got $4,000 of our Social Security will be taxed, which is 10% of our total benefit, $4,000 out of the 40,000. So only 10% of our Social Security is taxed in the second calculation or example, whereas more than half of it is taxable in the first example. So this is how it looks on a tax return. The first example is the middle column there. Our total federal income tax is $3,237, whereas in the second example, our total tax bill, federal tax, is $70. Significant difference based on just throwing Social Security into the equation and how it fits with all the other moving parts. So then I mentioned we've got the other 5 that I'm not going to go into detail on, but these really do complicate the tax brackets. So the first section of what we've talked about today is we talked about the marginal tax rates, but now let's talk about the effective marginal rates, because when another dollar is added in to our income tax, what is the actual effect? Is it going to be just 15% of that extra dollar, or is it going to do something else? And I'm going to show you, remember here, this is our ordinary income tax map that makes it look pretty simple. And this is our long-term capital gain and qualified dividend tax map that makes it look really simple. So let's look at a tax case, a case study here, and how the tax system really works. So we've got John and Jane. They're married, filing jointly. They're both over 65. They've got $50,000 of combined Social Security. They've got $15,000 of net long-term capital gains. They've got $25,000 of required minimum distributions. And they have an income need to maintain their standard of living of $60,000. Okay, so we're going to throw all this in, and the purpose of doing this is to show you what the effective marginal rates are, not just the marginal rates, but the effective marginal rates, and this will surprise several of you. So here's the tax map based on that case study that I just gave you in that fact pattern. You can see that once they harvest a little over $10,000 in ordinary income, over here on the left side of your screen, they begin to experience an effective marginal tax rate of 18.5%. Okay, that's an effective marginal rate. Then, that's the point that their ordinary income plus capital gains drags enough Social Security into the calculation to begin making every additional dollar withdrawn from an IRA taxable at 10%, and each additional dollar over that drags 85% of Social Security into the mix. That's how we get to the 18.5. Okay, and you can see that this couple never really experiences the 10% or the 15% tax brackets. Okay, right here on the screen. They never see this or they never see this. They start at the 18.5, jump to a 27 3/4, And then, yes, they actually vault to a 55.5% effective rate before they drop down to 30%, and then they're back to 25%, and then they follow the ordinary income tax brackets that we all think are there, but in effect, they're this, and the 27 3/4 and the 18.5. And you don't find those in the tax brackets that the IRS publishes, but this is how it works because of all the pieces coming together. So you're probably saying, wait, how did 55% happen? There's no 55% tax bracket, so how did that happen? So let's walk through it intuitively. If you pull $1,000 extra out of your IRA, you would think, okay, 15% tax bracket, that's $150. That's what makes sense to me. Well, what actually happens is this. The $1,000 comes out of the IRA, 15% tax bracket, $150. So far, so good. Well, that $1,000 caused another $850 of Social Security to become taxable at the 15% rate, so $127.50, which caused another $1,850 of our capital gains to be taxed at the 15% rate, $277.50. So it actually caused, from just that $1,000 extra IRA, caused $550 of that to go to Uncle Sam. Who would have known that we had a 55.5% tax bracket just for pulling out $1,000? And there's a similar tax impact on the capital gain brackets as well. So if you knew that you were going to hit this at some point, and you were planning to sell stock with a $40,000 capital gain, and it was going to throw you into a 40% rate, and 40% of that would go to Uncle Sam, you might decide instead to only sell 30 or 35,000 this year and put the rest off into next year and avoid this spike. That's what we need to do with our tax planning. So how do we control all of this? I've been advocating for years now, we need to diversify. We need to diversify among our taxable accounts, our tax-deferred accounts, IRAs, our Roths and other tax-free type accounts, and non-qualified, which are currently taxable. So we want some tax diversification on our type of accounts, and use tax-deferred products when it makes sense to, and then decide how we're going to withdraw from these accounts to make sure we're minimizing our taxes to the best that we can. So on the screen here is from some new software that we've acquired that helps us do this more detailed planning. And this couple here, hopefully you can see this. This couple here, Joe and Jill, they're both over 65. We're just going to show in our first analysis here $50,000 of an IRA withdrawal. No Social Security or anything else, just $50,000 in a withdrawal from an IRA. And this is what the tax map looks like. It's just the ordinary income tax brackets, as we've shown before. So $50,000 of income, their tax is $3,304. So even though they're in this 15% tax bracket, their tax bill was only $3,304, or an effective rate of 6.61%, which is just 3,304 divided by 50,000, gives you the 6.61. Okay. But now let's look at another example. They've got Social Security of 35,000, so they're going to drop their IRA withdrawal to 15,000, and what we have on the right-hand side is now their new map. This green dot was the map prior, and this red map, or this red dot, sorry, is their new tax. So income, down here in the bottom where I'm pointing, their income was $50,000 in the previous example. We've modified it to $50,000, so it stayed the same. Their total tax was $3,304, but we reduced it to 0, so we've got a tax savings of $3,304. Their effective rate was 6.61 before. We've gotten it down to 0. And you're saying, how is that possible? I pulled $15,000 out of a taxable account and I don't pay any tax on it. That's correct. It's absolutely correct. So most people put off their distribution stage 70 and a half when they're required to, when sometimes it makes sense to start pulling it out earlier so that we can take advantage of some of these planning ideas. So if you needed $15,000 to live on in addition to this $35,000 of Social Security, and you had it in the bank or some other account, you might choose to take it out of one of those other accounts, but I would still say, let's take $15,000 out of the IRA because we're not going to pay any tax on it. Let's take advantage of this 0% rate here and take it out while we can. Well, hopefully this has been informative. Hopefully it's been eye-opening to you. Obviously, your personal tax map is going to vary significantly based on what I've shown you, and it's going to be different based on your own circumstances. So if you'd like to see how your own personal tax map looks and some planning opportunities, schedule an appointment with me. If I don't have your tax return already, get me a copy of your tax return, and then we can quickly do your tax map and take a look at it and make some planning strategies based on what we see. Hopefully this has been informative to you. And finally, a quote to end up with. This is one of my favorite quotes from Judge Learned Hand. I even like his name. Judge Learned Hand, that said, "Anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the Treasury. There's not even a patriotic duty to increase one's taxes." In fact, I think there's a patriotic duty for us to do our best to pay our fair share and no more than that. So again, hopefully this has been informative to you. We have recorded it. We will post it to our website as soon as our technology people can do that. If you have questions or would like to see how this applies to you, please reach out to me, to Kate, to James, make an appointment with us, and I look forward to seeing you and hope you have a wonderful day. Bye-bye.